Hello and welcome to MF Corner. I'm Sonal Bhutra. With me as always is Vinnii Motiwala. Wishing all our viewers a very happy new year. May 2026 be the year of better investments, more diversification and better asset allocation as well. And that is something that we'll keep discussing on the show. And first day, so we start with a very specific category because we want to break it down for our viewers, whether they should go ahead and invest in that and what makes sense for them. Hey, Vinnii.
Hi Sonal, Happy New Year to you as well again, but Happy New Year to your viewers as well. What we're going to break down for you all today is going to be hybrid mutual funds. Now, volatile markets in 2025, we did see hybrid mutual funds that picked up pace. But why is it stealing the spotlight? What is it? What is the growth potential there of equities and the stability that it brings with debt? That is why it's become interesting. Now, these funds come in almost 7 SEBI-defined types that are there. Conservative, hybrid, aggressive hybrid, there's balanced hybrid, dynamic asset allocation is there for equity saving funds, arbitrage is there. Hybrid and multi-asset allocation are some of the types of these funds that exist. Now, what will it mean in terms of different investors who should be looking at it? What should your portfolio allocation actually come in for hybrid funds as well? To discuss all of this, the differentiation between all these hybrid funds as well, we'll talk about all of this with Kirtan Shah, founder and CEO at Truvanta Wealth, as well as Nisreen Mamaji, certified financial planner and founder at MoneyWorks Financial Services. Nisreen as well as Kirtan, good afternoon. Thank you so much for joining us on the show, and a happy new year to both of y'all, your families as well as teams as well. Thank you so much for joining us. Let's just start with the basic first. Key differences that are there between these different kinds of fund, whether you look at an aggressive, balanced aggressive, hybrid, multi-allocation, equity saving fund. What is the major difference between all of that in terms of debt, equity allocation that comes in here? Kirtan?
Vinnii, Sonal and everybody at the studio, a very happy new year and all the viewers. I think like you rightly started, Vinnii, there are 7 different categories. The major difference between each of these categories is their allocation to equity, debt, or probably a precious metal or inventory outside of equity. So if you understand how much allocation goes to equity and how much allocation goes to debt and how much goes to something else outside of both of these asset classes, then you will understand the difference between all of these categories. So to give you an example, if you look at the conservative hybrid. Now, in this category, when you invest, you have to actually expect 10 to 25% of the allocation will go towards equity, and the remaining 75 to 90% of the allocation will go towards debt. You look at balanced hybrid, it increases the equity allocation. So the equity allocation is roughly between 40 to 60%, and the debt allocation is the remaining 40 to 60%. But over here, in the equity allocation of 40 to 60%, it is very categorically mentioned that you cannot take positions in arbitrage. So the equity has to be pure equity. If you look at aggressive hybrid, then it increases equity component even more to 65 to 80%, and the debt component is lower at 20 to 35%. But when you look at the balanced advantage fund or the dynamic asset allocation fund, now there is no minimum given here like the other 3 that we discussed. Over here, the equity and the debt component is typically dynamically managed by the fund manager, depending on their understanding of whether equity is overvalued and undervalued and how do they really want to allocate more money to which asset class. But the interesting one here is actually the multi-asset allocation, which is the most common fund now spoken about these days, is because it is the only fund that typically takes a larger position in precious metals. So the basic definition says that you need to have minimum 10% in 3 asset classes, and then the remaining 70% can go anywhere, right? But so you will typically have 10% in equity, 10 in debt, and 10 in probably a precious metal. And the 70% will be on the discretion of the fund manager to decide where she thinks needs to be more allocated. And the last is the equity savings fund, where again 65% is equity and a minimum of 10% needs to be debt, and the remaining can go wherever. But here the distinct feature is that the 65% equity that we speak about can have arbitrage allocation also. Right? So that's how each of these categories are different from one another. But the basic difference is the allocation that they actually have to either equity, debt, or precious metal or alternates.
Okay, so a lot of segmental breakup when we talk about hybrid funds. It's not it's not a vanilla fund when we talk about, say, large cap or mid caps or pure equity funds. Thank you for explaining that to us, Kirtan. Nisreen, let me start with you now, because we've spoken about how the multi-asset allocation category did really well amongst all these segments. How have hybrid categories generally performed historically amid market volatility? Which of these have delivered the best returns? Is it, somehow connected to the cycle that we are in, or other aspects of the market?
Oh, that's a very interesting question, actually. So basically, what happens is that the best returns is also kind of very, sort of comparative or figurative in this sense, because it depends on which time frame you're looking at also and what has happened during those years. So for example, what the hybrid fund is designed to do is give you the downside protection. So suppose there is a bear market and, there's a sharp correction like what we witnessed in 2020. There, the hybrid funds will significantly see lesser declines than the pure equity funds, simply because the allocation towards 100% equity is lower in a hybrid fund. Also, in terms of the risk-adjusted periods, like if you're looking at a longer period, say 5 to 10 years, the aggressive hybrid funds sometimes have actually delivered quite comparative to, say, a large cap fund, sometimes even better. So, and with a lower standard deviation or a lower volatility. So therefore, even you have to be very careful when you're investing in the hybrid fund, because here you're looking at protecting the downside and possibly getting an equal, return compared to the large cap category. So I'll give you an example. Say in a 5-year compounded annualized growth rate tenure, ICICI Prudential Equity and Debt Fund, which is a hybrid fund, has given about 27 to 28% returns, 5-year annualized. UTI Aggressive Hybrid Fund has given also 23-24%. And similarly, Kotak has given about 23-24%. So if you compare with the large cap category, say in the 5-year segment, you'll find that to be more or less similar. The returns are similar with a lower, risk of volatility. Now, the dynamically managed funds, such as, the balance advantage funds or the dynamic asset allocation category, these specifically tailor-make their asset allocation based on the market valuations, and they are much quicker in adjusting between arbitrage, equity, and bonds. So here, the principle is buy low and sell high, for example. So there you can manage your risk and you can enhance the performance also in that particular category even in shorter periods of time.
Right. Thanks for explaining that, Nisreen. Kirtan, given the historical returns or the performances that one has seen, who should actually go for something like a conservative hybrid fund over a pure debt fund, and why? What are these differentiating factors that I should be, or one investor should be actually picking conservative hybrid fund? What kind of investors?
So I think, Vinnii, what we first have to understand is there is a large difference in taxation when you discuss a pure debt fund versus a couple of categories in the hybrid space. Now, in fact, if I'm allowed to, I would rather suggest that somebody who's probably looking at conservative investment may actually want to look at an equity savings fund in this category versus a pure debt fund, then a conservative hybrid. And I'll explain to you why. You look at the standard deviation of, let's say, a conservative hybrid, which is your question, versus equity savings, which I'm trying to say. The standard deviation of both of these categories is more or less the same, right? So the standard deviation is 3.75 in case of a conservative hybrid, and it's close to 4.2, 4.3 in case of equity savings. So with the same kind of risk or standard deviation in both of these categories, we've seen that the equity savings fund over 1 year, 3 year, 5 year, 7 year, as well as rolling and point to point, have done a much better job than a conservative hybrid. So if you look at a 5-year, probably a conservative hybrid has done 9%, and equity savings that I'm talking about has done a 10.2. You look at 3 year, 7 year, you will see the same data point. So the point that I'm trying to make is that while your standard deviation is more or less the same, if you have 3+ years of investment horizon, an equity saving will do a much better job than a conservative hybrid versus a debt fund, because of course they are doing much better in terms of return, of course, versus a debt fund category, and they're much better in terms of taxation versus the debt category. Because in the debt category, irrespective of your investment horizon, you are still going to be taxed at your slab rates. But if you end up taking an equity savings, you will be taxed at the equity taxation rate, which is 20% for less than 1 year and 12.5% for more than 1 year. So what you are ideally doing is, with probably the same kind of risk that you end up taking, you will be able to generate much better returns than probably a conservative hybrid as well as a debt category product. And at the same time, the taxation is extremely favorable in your case versus paying slab rate. You will end up paying a 12.5% if you hold for more than a year. So if a conservative investor wants to invest and has 3-year kind of investment horizon, I think they should actually look at a equity savings versus even a conservative hybrid or probably a debt product.
Okay. All right. Take that point, Nisreen. Do you agree with Kirtan's points? Anything that you would like to add to that?
Yeah, sure. In fact, I did want to. So, your question was who is the ideal investor for this kind of a category? So I think, people who are new to the market, say a new investor, can use these funds as a starting point. So say an equity savings fund with an equity allocation of say 10 to 15%, the rest an arbitrage and bonds, This would be very good for a new investor to start getting comfortable in the equity markets because maybe they are FD investors. They've never invested in equity. So this is, will give them a kind of a preliminary idea as to how equity can perform without them taking the entire risk. As explained earlier, the standard deviation and volatility is lower in, say, an equity savings category. And the minimum amount you can go for equity, which is, say, in the range of 10 to 15%. So when they start getting comfortable with a market-linked investment, a new investor gains the confidence to start increasing the equity allocation, even in the hybrid space. Then another category which is very well suited for hybrid funds is an investor which is close to retirement. Because here what you're trying to do is, you are trying to take away the risk of the market and the volatility and slowly get into, maybe 100% pure debt fund once you're retired or closer to the retirement age. So these are the people who will transition slowly and get into, from an equity fund to a hybrid category and then maybe lastly to a pure equity savings so that the corpus is not affected greatly by swings in the market. So that, those are the two investors who come to mind when, for who is the ideal investor, and anyone with a, conservative or moderate risk tolerance would be an ideal investor for hybrid funds.
Okay, Nisreen, thanks so much for that. New investors, conservative investors, don't want to take much risk. You can look at this as well. But on that note, we're actually going to slip into a very short break. We're going to continue this conversation after the break as well.
Welcome back. You're still tuned into MF Corner and we're discussing hybrid funds, the categories underneath the bigger name and which category suits which kind of investor. Nisreen, let me start with you on this one because we talk about different risk categories. So if we talk about moderate risk investors, when does a balanced hybrid outperform the aggressive ones, especially for somebody having a medium-term goal, say 3 to 5 years?
Sure. Actually, that's a very pertinent question. Because, a moderate risk taker would always like to know when, which is the ideal time period, what are the kinds of, investing periods when these kind of funds will outperform. So typically, when there are about 3, time periods when this kind of fund, moderate investor will benefit, moderate risk taker will benefit. One is, when the market is volatile or moving sideways or range bound. So, for example, between 2010 to 2013, between 2018 to 2019, or between 22 to 23 when the market was moving like this. So here the aggressive hybrids will suffer deeper NAV swings due to the higher equity. And balanced hybrids will have less loss during the fall, obviously, because the equity component is only lower, and they have the ability to recover faster. And also they benefit from the debt portion of the, of the fund, because there will also be debt and there will be arbitrage. So this tactical rebalancing will very much aid this kind of a fund when the market is volatile or basically moving sideways. Then also in a situation when there's a sharp correction, like say 20% or more. Example, 2020, there was a crash. In 2022, there was a global tightening cycle. This is a time when there's a typical max, there's a drawdown happening when the markets are falling. So say an aggressive hybrid fund would have fallen, say, 25 to 35%, but a balanced hybrid category would possibly fall between 12 to 18%. So there again, that kind of an investor would, see a positive return, a lesser drawdown. Also, when there is a rising interest rate cycle, there's tight liquidity in the markets. That is the time also when the balanced hybrid fund will do much better because they will earn steady debt accrual from the debt portion of the funds, and the rebalancing will happen into equity at lower levels. When they're rebalancing, equity is lower and you're moving from debt into equity. So there again, you will benefit as a balanced hybrid category. So these are three, specific time periods of specific, market environments where a balanced hybrid category investor would be benefited compared to an aggressive or 100% equity investor.
Sure, point taken there, Nisreen. Kirtan, anything that you would like to add on that front as well for moderate risk investors? What would you say that they should be watching out for or looking at in terms of the hybrid funds, as well as in terms of portfolio allocation? How should one go about it, right? For the long term, how should an investor allocate between these funds?
I think, Vinnii, I have a slightly different view. I think that if you are a moderate investor with 3 to 5 years of investment horizon, you ideally don't want to look at balanced hybrid. You actually want to look at balanced advantage funds or dynamic asset allocation funds, because both of these categories are very different. And like I was explaining to you earlier when I was asked this question, that the balanced hybrid, unfortunately, has a problem with respect to not being able to do arbitrage. And their 40 to 60% allocation has to be equity allocation purely. And plus, they are not great when it comes to taxation versus a balanced advantage fund or a dynamic asset allocation fund. So if a moderate investor with a 3 or 5 year view, I would rather suggest that she looks at a balanced advantage fund or a dynamic asset allocation fund, because that is where the fund manager has the flexibility to be able to move the allocation between debt and equity depending on the market valuations of or market prediction, if I may use that word, even if from a futuristic point of view, from a fund manager standpoint. So they will typically add more equity when the markets are probably available at lower valuations, and they will tweak the equity component of the asset allocation lower when they think markets are expensive. I think that's a better bet, in my opinion, from a hybrid category for a moderate investor from a 3 or 5 year view. Also, to answer your second question, I think hybrid funds are for each category of clients, in my opinion, or investors. Let's say, for example, if I am somebody who's probably not very aggressive as an investor and more conservative, I'm okay to do all my investments in hybrid category. Let's say 70% of my investment can be equity savings, 15 can be BAF, and 15 can be multi-asset. But if I'm a moderate investor, I would rather stick to a 50% allocation to BAF and 50% to multi-asset. And even if I'm an aggressive investor, I would really want a 10-15% allocation to multi-asset, because that gives me allocation to precious metals like gold and silver, or alternates like REITs and InvITs, which otherwise would become very difficult for an aggressive investor to be able to build in the portfolio. So I think hybrids are for everybody, in my opinion.
Okay, but as you said, you slightly differ, but different opinions is what make the market and investments more interesting, right? So take that point as well, Kirtan. Nisreen, coming to you, when we talk about portfolio allocation, say 40% conservative, 60% aggressive, what kind of allocation will maximize diversification for a longer term investor in this case?
If you are a longer term investor, then, depending on, of course, your risk tolerance, because you've already answered the tenure is longer term. If you're able to take the volatility, then obviously closer to 100% would be very, very, the best investment for you, because the longer the time period, the volatility has been noticed and, obviously the markets work in such a way that the volatility will be ironed out, and you would get at least the XIRR that you want to, take. But the issue here is that, people say that they are longer term investors, but I mean, how many folios are there, for the last 25 to 30 years without any switches? So you also have to see the statistics and, people's behavior when we talk about the long term, in this case, actually. So that is the reason that, theoretically, obviously it will work. An investor is going to be investing in 100% equities if you're looking at the longer term, which is anywhere from 15 to 25 to 30 years. But practically, if that is not what is actually worked out, what you tend to do is, have a mixed bag of investments, say 80% equities, 10% in a multi-asset fund, and 10% in, say, an equity saving or even a debt or arbitrage category, in order for you to be able to sustain the volatility, which is part and parcel of an, equity investor. So also, you might have, emergency withdrawals, and there will be so many situations where market may not actually, support a withdrawal at that time. For that reason, it is very important to have hybrids in your portfolio, and obviously not go for the just theoretical viewpoint, which is say 100% equity, even if you are a high risk investor. So a balanced investment, say 70% in, 100% equities if you're a long-term investor, 10 to 15% in multi-asset and BAF, and say 10 to 15% in arbitrage or fixed income would be very ideal for an investor with a longer time frame, period ahead of it.
Okay. Kirtan, overall in my portfolio allocation, what should be the allocation to hybrid funds? And could you also maybe help our viewers and tell them which funds to invest in for each hybrid category?
I think, like I said, each of these hybrid categories, in my opinion, are for each kind of investors. And I kind of preempted a little and answered this question the last time I was asked. But just to reiterate, I think, let's say, even if you are a conservative investor, you still don't want your entire portfolio to be in fixed income, because post-tax you will not be able to beat inflation. So hybrid is a great way to allocate more money, where you are able to post-tax be able to generate inflation-beating returns. So if I'm a conservative investor, I would stick to, let's say, a 60-70% of my portfolio to an equity savings fund, because like I explained earlier, the tax is at 12.5%, and the returns over 3 or 5 year have been far better off than a conservative hybrid or even a debt mutual fund at 9-10%. So I think 70% allocation as a conservative investor to equity savings, and probably the remaining 15% to, let's say, a dynamic asset allocation fund, and a 15% to a multi-asset fund, because what that will end up doing is keep my equity allocation as a conservative investor under check, but at the same time give me exposure to precious metals and probably a little alternates without really increasing the risk on my portfolio. Now, the typical misconception is, let's say if I'm an aggressive investor, why do I need to invest in debt or probably a hybrid? I think, in my opinion, even if you are a very aggressive investor, it is absolutely no harm have 10-15% in multiple.
All right. Kirtan, actually it turned out to be such an interesting conversation that we lost the track in terms of time. But thank you so much, Nisreen and Kirtan, for joining in today with your thoughts and explaining to us more about hybrid funds as well. With that, we'll do one thing. We'll take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.